both of those assets in the same portfolio is helpful because you can kind of get the best of both worlds. Apartments have usually better appreciation and depreciation tax benefits, but storage has very strong cash flow, reliable cash flow.
Hi, this is Steve Davis with the Total Wealth Academy podcast. Welcome. If you're not familiar with the Total Wealth Academy podcast, what we do is we talk about really all aspects of a balanced life: fitness, family, spirituality, everything. But our biggest focus is on building a second stream of income with real estate. And we invest in everything from single family houses to apartments, senior living, strip shopping centers, and self-storage. And what we're going to talk about today is self-storage. I've brought together an expert from self-storage. He actually just purchased a big amount of self-storage, but I want to give you a brief overview of why we like self-storage. Everybody loves apartments. In fact, probably 80% or 90% of the deals we do are apartments. And the big sales pitch is, whether the economy's up or down, everybody needs a place to live. So they do well in both the up and down markets. But what people don't realize is it's the same for self-storage. Let's go back to 2008, 9, 10, 11, the Great Recession. Catastrophe, right? Not so for self-storage. While all of these people were losing their homes, 2, 3, 4,000 square foot homes, and moving into 11, 12, 1,300 square foot apartments or in with their parents, whatever the circumstance was, what were they doing with all of their stuff? They were putting it into self-storage. So self-storage blew up during the recession. You think, well, it's a recession, it's a bad time. No, not for every business. It's all about position. If you were in self-storage at that time, then you saw your income go up, your net operating income go up, your values go up. It was just a phenomenal time. But the opportunity is consistent even in the up market. It is a great place to put your money where you're getting cash flow, you're getting appreciation. It's just a great investment. And let me introduce you to Joe Pizzurro. Joe, welcome to the show.
Thank you. Glad to be here.
Good to have you. He actually just purchased a large group of self-storage units. So what we're going to start off with is just let's have him tell you a little bit about that deal and what it looks like in the future. So Joe, tell us a little bit about the deal and what you're anticipating over the next 3 or 4 years.
Yeah, no. So I think one of the reasons we were attracted to it, it's got some repairs needed that the seller couldn't afford. And so we have our own in-house general contracting company. So we can make those repairs at a much lower cost than some others. So that was an opportunity. Also, they were managing it a little differently. We tend to have lower payroll, and we have a lot of automation we put into these properties, like automatic gates, access gates, automatic digital locks, where you can rent a unit online, come to the facility, get in the facility, and go to your unit and open the lock with the code we provide you, all without needing to talk to a person. While we don't eliminate all staff, because I think that causes some problems, but we reduce staff. And so we're able to save a lot of Opex and a lot on the CapEx. So, but another reason, besides the thing you pointed out about self-storage, is it's sticky tenants, they call it. You can raise rents pretty easily without attrition, because let's say you do a 10% rent increase across your whole storage facility. Well, the average units may be, $50 a month. So that's like a $5 increase for the tenant. Are you going to go spend the day moving just for $5? Most people just accept it, right? Yeah. So that's another reason.
What is the IRR, internal rate of return, or ARR, depending on which one you used? What are you looking and projecting for this particular deal? And tell them a little bit about the cash on cash rate of return as well.
Yeah. The AAR is about 19, close to 20%. We're looking at probably a 1.9 or between 1.9 and 2x equity multiple in a 5-year period. And then
Excellent.
the cash on cash is around just under 9% is where the average. So if you take the average cash flow of each year, it's going to increase every year. But on average, it's around close to 9%, which is pretty good for, like you said, we're in a kind of a tough market right now. Even with the higher interest rates, we're still getting 8 to 9% cash flow. Whereas a few years ago, storage was getting, 10, 11, 12% cash flow. It's still, and that's just because it requires less Opex to run, less utilities, less payroll, less maintenance. So it just naturally has a lot of net cash available.
So bottom line, somebody who invested with you in this deal is making about a 20% rate of return, which is double what the stock market produces. And it's producing monthly cash flow that they can actually live off, pay their bills, which is the big goal, get enough passive income that it meets and exceeds your bills. Well, that's a big step. You put $100,000 in, there's $10,000 a year right there. That pays a lot of bills. Where are these located?
We're in Arlington, Texas. So that was another good location where you got, the Cowboys stadium down the street. You've got the University of Texas, Arlington campus. There's a Whole Foods, there's a Starbucks. It's a very busy area, a lot of traffic. So those are good spots because it's just constant traffic. That's good to have around storage. And there's a lot of multifamily surrounding them. And so that's another, like you were mentioning earlier, a lot of our tenants are multifamily residents. So when there's a lot of multifamily nearby, that's another good thing you want to look for.
And how many units did you pick up?
659.
659?
Yes.
Wow, I was thinking it was down near 400. That's a big chunk. Congratulations.
Yeah, and we're adding a few more. Some of the storage properties, they have like a live-in little suite connected to the office, so the on-site person sometimes will live there. They weren't taking advantage of that, so we are adding 3 new units to the rent roll. So it'll be 662.
Nice. Nice. Well, let's talk now about why you're so excited about self-storage. Because you were an apartment guy, what
Yep.
got you motivated to go out and buy 600 plus units of self-storage?
Well, it was a few years ago, and I still look at buying apartments. Actually, I'm still acquiring them also, but it's a different strategy. A lot of my investors want cash flow, and right now, with apartments, there's good strategies like buying at a good basis. There's a lot of upside potential, but cash flow hasn't been very great for multifamily the last few years. And so I pivoted because I'm trying to cater to my investor network. That's what they want. They don't want to wait 5 years to get their money. They want to see it happening. And so that's one thing we do a little bit differently. Not every group does this, but we do monthly distributions. Some do quarterly. But some of them say, oh, no distributions until the second year, or we do it right away every month, just because I know that's what a lot of people prefer. And that was one way we found to do that, was with storage. So we don't want to stretch ourselves too thin. I wouldn't want to wear too many hats, but I think having both of those assets in the same portfolio is helpful, because you can kind of get the best of both worlds, where apartments have usually better appreciation and depreciation tax benefits, but storage has very strong cash flow, reliable cash flow. So that's the other part.
Yeah. And it depends on your investor, but I think you're right. The majority of them are looking at that cash flow. They understand they're getting the appreciation, the equity buildup, and so on. But boy, they love seeing that check in their bank account every month. lets them know it's real, that it's really happening.
Yeah,
So
and I think in addition to some of them need the passive income because they're retiring or they want supplemental income, but also it's like a good reminder, and it builds confidence that the investment's working. You know,
absolutely. Absolutely. So how many apartment units do you own now?
I've got about close to 500 units of apartments, and then about 4,500 of storage. Now, obviously, storage units are cheaper to buy, right? They're
Right.
smaller, but yeah, about we just surpassed 5,000 total units in our portfolio.
Wow,
So
congratulations. Yeah, and the management of these things is a lot easier
a lot
than the
easier.
management of an apartment complex.
Yeah.
Um, Take people through how many people are on a team to run an apartment complex?
Usually on a 100 unit property, you have one manager and one maintenance person, and then you're gonna upgrade, you're gonna scale that up. 200 units, you'd have two and two, and so on. 300, you'd have three and three. So usually for self storage, we can use one manager for up to 500 units.
Wow.
Um, and some of them, like if it's usually 200 units or less, you could run it without a manager usually.
Just
Um,
a salesperson.
right, or even just with not manned at all.
Wow.
Uh, so it just depends if it's a busy area and a lot of traffic. Usually you can do that, but if there's more online rentals, but yeah, about 500 units needs one person, so it's a lot different ratio.
Yeah, a lot less payroll, to say the
Right.
least, for sure. Um, as a future for Breakchain, your company, do you see you? It really seems like your portfolio is obviously dominated by storage. Do you see that continuing, or with the things that are happening with apartments right now, like there's going to be a huge number of foreclosures on apartments
Hmm.
coming up? Do you see yourself buying some more apartments?
Yes, we are buying some more apartments, so that number is going to go up. But we're also going to keep buying storage. So I think, like you mentioned, it does well in both markets, up and down. So no reason to stop buying it. Yeah, we're going to continue building both of those.
When you focus on reducing expenses, you're reducing expenses, you're reducing payroll, you're really increasing your NOI dramatically in a short period of time.
Right.
With apartments, a lot of times we'll buy them, refinance them in a couple of years. Do you do the same thing with your self storage?
Not as quick. We wouldn't refinance it as quickly. One benefit of apartments, you get to use. You have access to more loans like housing, like the Fannie and Freddie. You can't use those on storage. So we tend to use like a CMBS loan, which, it's more of a 5-year term. But yeah, we typically a 5-year hold.
So you
But,
either
yeah, I was going to
refinance it
say,
at the end of 5 years or you sell it.
yeah, we do if we can. Otherwise, we would exit and just sell. But if we can return everyone's uh, projections through a refi, that's even better. Then we can hold the property. Um, but this recent deal we closed, you're right. In the first month of operation, we increased the NOI by 30%, and that was due to the difference of the Opex. So that was a very fast value add. But the reducing Opex happens a lot more quickly, and you have more control over that, versus the other way to increase NOI is raising revenue. That could take longer. Depends on raising rents and occupancy. So that's the other way to raise NOI. They sometimes can take longer, but that was the highlight of this deal, was the first month we cut OpEx by 30%.
Wow. Well, one thing the viewers need to understand is that the net operating income pretty much dictates the value of the property. If you increase your NOI for 12 months at 30%, you've really increased the value of your property by 30%.
Right.
So this is a big deal when I hear, hey, we cut out 30%. We increased our NOI by 30%. That's phenomenal.
Yeah, no, and like I said, usually without that opportunity, it might take you 3 years to do that. So,
Oh,
uh,
yeah. Yeah, that's an incredible jump. So the future of break chain is going to be a combination of apartments, self-storage. Are you considering strip shopping centers, city centers, any other things?
yes, I don't have the experience there, but I'm very interested. I also do passive investing myself, so I am interested in that also. Those are, I think the benefit of those are like you that's even less work than
Yeah,
in storage.
the triple net lease.
Yeah, yeah.
Yeah, we've got one of the sponsors who's actually building a city center, 22 or 23 acres. And that project is looking at something like a 25 or 30% IRR. Um, that's just insane when you think about it compared to apartments or anything else. So, yeah, I like your idea. Hey, I'll do some passive investing in trip shopping centers and city centers because the rate of return is astronomical.
Yeah.
Um, let's go way back just for a minute. How did you end up a sponsor? How did you end up a syndicator?
Yeah, well, I started out buying single family, like most do, and I tried to educate myself on, just taking the next step. The way I've described it before is in the monopoly game. You can have those green houses, but then there's the red hotel, and like I wanted the red hotel. So in real life, how do you do that? Well, to me, it was graduate to multifamily. And so I started investing as a passive investor. And then, I joined a lot of groups and kind of learned, and your group as well was very helpful. Your group actually has is the best of both worlds because, sponsors can join and get access to educated investors, and then passive investors can join and become educated and get access to deals. So it's kind of a win-win for both. But through groups such as yours, I got to be a sponsor, and I went big for my first one. I went for an 89 unit apartment, and was able to raise the funds and close it. So and then I kept going.
How many single family did you have before you moved to the
Ju-
80?
just two. So
Wow,
I didn't
that's
wait.
a big
I didn't
leap.
wait long.
So was that a 2-year period, a 3-year period?
It was about after 3 years is when I started, focusing on trying to build this company, and then it took about another year or two to really start getting traction. So um, so it took maybe like almost 5 years to get going. Um,
Okay. Well, let's go back even a little bit further. What was your motivation? What were you doing before?
I was in the corporate world, and great experience with management skills, with working with stakeholders, presenting, all things that you use still in this business. But I think there was a limitation of like a ceiling. You
Yeah.
couldn't you couldn't get above a certain, it's like a ladder. And looking at my 401k, I was thinking, okay, in 20 more years, I'll be where I want to be. And I thought, there's got to be a faster way to do that.
Yeah.
So I started, I actually, everyone I talked to say that the first book they read was Robert Kiyosaki's Rich Dad Poor Dad. I
Absolutely.
actually eventually did read his book, but I heard Grant Cardone speaking, and that kind of got me. He's like, cash out your 401k, put it in real estate. He's a
That's for
little
sure.
extreme, but I love it.
Yeah.
Yeah,
Well, one of the things people need to understand is you can invest in real estate with your 401k
exactly. Yeah.
without paying the tax or penalty. So there's two options. One is tear off the bandage, pay the tax and penalty, get your money out of the 401k. The second option is leave your money in the 401k, but get it out of the stock market and into real estate.
Mhm.
And that's what the majority of the members of Total Wealth Academy are doing. They're using their IRAs and 401ks to invest with Joe and other sponsors to get, double or triple the rate of return they're getting in the stock market with lower risk and lower volatility. So that's a great story. And I fully understand 2 points that you made. One is the ceiling.
Mm.
If you make too much money, they're going to come in and cut your pay or change your commission slide or something like that, so you don't make as much money. And then two, it's the get rich slow idea. Well, in 20 years, I'll be where I want to be, but 20 years of your life are gone. That's not the way to do it. The way to do it is the way you did it, which is there's got to be a better way. Go out there and find it and make it happen a lot faster. I remember when my financial planner told me, yeah, if you save up X amount of dollars a month for the next 30 years, you'll have $1 million when you retire. I wanted to punch him. I was like, I don't want $1 million when I'm 65. I want $1 million now. How do I get it now? So that guy actually, I credit him with motivating me to go into real estate. If he hadn't have said that, and if I hadn't had that epiphany that, man, I'll be old by the time I have any money,
Mhm.
I don't think I would have made the change. So you
Yeah.
kind of got the same impression, I think.
Yeah. Yeah. And no, and part of it is also just it takes some confidence, to make the leap.
Yeah.
Because at some point you you're one leg in, one leg out, but you gotta eventually put both legs in. So that's where it takes some courage sometimes.
It does. And I think, sorry to give a sales pitch for Total Wealth Academy, but that's where being a member of a group helps.
Hmm.
When you start hanging out with people who have already done it, they've already taken both their feet into the water, and they can tell you they were scared, but they did it anyway, and they've succeeded. It's encouraging, and it eliminates a lot of the fears that people have. So, did you have a major mentor?
I wouldn't say a major one. Just I joined several different groups. Listened to several different mentors, and kind of just pieced together because everyone had a different angle or different experience or
Yeah,
different background, and kind of ended up learning from different groups and then building my own approach. I actually built my own underwriting model that I pieced together from just learning from others, but also through my own experience, that works well for these particular deals.
very cool. Very cool. So, you may have mentioned it, but I like to ask people before I let them go, what's your favorite book? What should the viewer read? You mentioned Rich Dad, Poor Dad. Is there another book?
I'm actually writing a book, but
Oh, wow.
I guess I won't announce it yet because it's not out yet. But I'm calling it Couch to Cash Flow, which is basically, a story that I think a lot of us can relate to. How to get from, you know, sitting on the couch watching TV to making cash flow. And it's a journey to do it.
Because sadly, you bring up a good point. Sadly, what the average person is doing is just going to their job 9 to 5, and they think that's the be all end all. That's all they have to do. And they go home and sit on their couch, watch TV, watch the game. You got to do more. Warren Buffett, billionaire businessman, said, never rely on a sole source of income, a job. Always invest to create a second source. Investing with you is helping build that second source of income. It's getting off the couch, educating yourself. Yeah, I like the name of that book. That's cool. That's cool. All right. I really appreciate it, Joe. Thank you so much for coming on.
Thank you, Steve.
All right. For those of you watching, I do have a recommendation. If this is your first podcast with Total Wealth Academy, go watch episode 1. Episode 1 gives you our complete mission statement and teaches you the most valuable lesson that I ever learned as an investor. That's episode 1 of the Total Wealth Academy podcast. Thank you so much for watching, everybody. Have a great rest of your day.